Ever notice how the wealthy play by a different set of financial rules? The reality is, they do. I'm about to expose their secret playbook and reveal 7 brilliant assets that look smart on paper, but keep you locked in financial struggle. These are not obscure investments. They're exactly the ones your financial advisor pushes, your family raves about, and you probably own already. As Warren Buffett once said, "What the wise man does in the beginning, the fool does in the end." While most investors chase these popular assets, the truly affluent steer clear of them. Why? Because the financial industry profits handsomely from selling you these so-called smart products. Each one highlights a fundamental misunderstanding of how real wealth grows versus how most people think it grows. The last asset I'll uncover is the most dangerous, combining emotional appeal with outright financial harm. It's what separates those who build lasting fortunes from those trapped in stress despite decades of hard work. These insights could save you hundreds of thousands of dollars over your lifetime and put you on the path to genuine financial freedom. Asset number 1, assuming real estate is a guaranteed winner. You've heard it 1,000 times. Buy property. Real estate never fails. Your dad said it. Your neighbor swears by it. Even your advisor likely nodded in agreement. Yes, real estate can generate wealth. But here's the catch. If a property doesn't put cash in your pocket every month, it isn't an asset. It's a gilded liability. Think about it. How often were you told houses only go up in value? In truth, the average homeowner spends more than $9,000 each year on hidden ownership costs, maintenance, property taxes, insurance, homeowners association fees before even touching the mortgage. Over 10 years, that's more than $90,000 gone. If the property's value never rises and it fails to produce net income, it does nothing for your net worth. Before you buy, ask yourself, will this place deposit money into my account or simply give me something nice to look at? A second home might feel like freedom, but if it drains your cash and steals your weekends, it's merely a burdensome view. Take Mike from Chicago. He bought a mountain cabin expecting a smart play, but ended up sinking over $50,000 into repairs, taxes, and upkeep in just 5 years. Meanwhile, Sarah invested that same amount in a small rental unit that now delivers $600 each month after covering every expense. The difference is stark. Sarah's property pays her, while Mike pays for his. That distinction is everything. Wealthy investors don't just own real estate. They acquire properties that generate consistent positive cash flow. They evaluate every deal by monthly surplus first, appreciation second. They calculate every cost: mortgage payment, taxes, insurance, maintenance reserves, management fees, vacancy buffers, and only if the numbers still show a positive cash flow does the property earn a place in their portfolio. You can even leverage specialized online marketplaces to find income-producing properties without the emotional baggage. And if you dream of a vacation home, build your cash-flowing portfolio first. Then, direct a portion of that passive income toward your getaway. That is how smart investors play the game. But while we're on the subject of safe decisions, ask yourself, what really happens to your cash sitting idle in a savings account? Asset number 2, parking all your cash in a standard savings account. If you keep every dollar in a low-yield savings account because it feels secure, you might not realize how costly that safety really is. That snug feeling could be draining thousands from your wallet each year. Many people over 40 grew up with the motto, work hard, stash your money, then retire. Sounds solid, right? But here's the catch. The typical savings account in the United States earns less than 0.4% interest, while inflation runs at a minimum of 3% every year. In other words, your balance is shrinking in real terms while it sits in the bank. Let's break it down. Imagine you set aside $10,000 for 5 years at 0.4% interest. On paper, you'd earn roughly $200 in interest. Yet with inflation at 3%, you would lose over $1,500 of purchasing power. You're not really saving. You're slowly eroding your own wealth. This isn't just math. It's about honoring the effort behind every dollar you've made. Cash parked in a low-interest account isn't working for you. It's quietly working against you. Traditional banks rely on your deposits to boost their profits, not yours. Consider Janet from Cortland. She left $50,000 in a conventional savings account for 10 years, valuing security. By now, she's lost more than $15,000 of purchasing power to inflation. Meanwhile, her brother Tom shifted his money into a high-yield account, earning 4.5%. With the same federal insurance safeguards, he actually grew his spending power over the identical period. Identical safety, vastly different results. The remedy? Transfer those funds into a high-yield savings or money market account currently offering 4% or more, still backed by federal deposit insurance. For even better protection against rising prices, look into Series I savings bonds that automatically adjust with inflation. Your money deserves far more respect than a 0.4% return, while your bank earns double-digit returns for itself. Make a move this week. It takes under 30 minutes to open a new account online, and it could save you thousands over the next few years. Asset number 3. Buying a brand new car as a personal reward. You've devoted years to your career, supported your family, and now you figure you've earned that fresh-off-the-lot vehicle. Society cheers you on, but the reality they never broadcast is brutal. A new car bought near retirement isn't a trophy, it's a costly liability in disguise. The numbers are unforgiving. On average, most brand-new vehicles lose 15 to 20% of their value the instant you drive away. Within 5 years, more than half of their worth has evaporated. Picture that for a moment. Half of your investment gone in a blink. Think about that slick $50,000 sport utility vehicle you've had your eye on. In 5 years, if you're fortunate, it might only fetch around $22,000. That's real depreciation you can't ignore. That's not an investment. That's a guaranteed loss of $28,000. For anyone past 40, the biggest blow is the opportunity cost. That $28,000 isn't just gone. It's money that could have been compounding in your retirement portfolio for years. At a conservative 7% return, it would swell to over $55,000 in 10 years, even if you never added another penny. Look at what Jim from Texas did instead. He skipped the new car markdown by buying a 2-year-old version of the exact model, with low mileage and most of the factory warranty still intact. He paid $35,000 rather than $50,000. Same comfort, same features, same reliability. Yet he had an extra $15,000 growing in his investment account. 5 years later, both cars settle at roughly the same value, but Jim's initial savings continued to multiply. Is that new car aroma really worth tens of thousands of dollars? We both know the answer. Here's the smarter play. Pick a 2 to 3-year-old vehicle with low mileage. You'll enjoy nearly all the perks and dodge the steepest depreciation curve. Use vehicle history reports and independent inspections to confirm quality. And if you crave a brand new ride every few years, leasing is an option, though rarely the cheapest one. True financial freedom isn't about driving something flashy. It's about letting your money work for you instead of evaporating in your driveway. But if you think cars are brutal on your budget, wait until that dream business of yours turns into a financial jail. Asset number 4, launching a business without a plan for detachment. You spent decades building someone else's dream, and now you want to be your own boss. It sounds perfect on paper. Start that small business you've been eyeing. Finally claim the freedom you deserve. Yet, here's the unspoken truth from reality, not from inspirational seminars. Owning a business only delivers freedom if it can run without you. Think about every small business owner you've met. Have you ever seen one less stressed than they were in a regular job? Exactly. Data from the Bureau of Labor Statistics shows 1 in 5 small enterprises fails in the first year, and half are gone by year 5. But even the survivors often end up working longer hours for less pay per hour than they did as employees, just with a fancier title. Ask any honest owner about work-life balance, and you'll get a chuckle. They're answering emails at 11 o'clock at night, grinding through weekends, and rarely enjoying an uninterrupted family dinner. Why? Because they've built a job, not a business system. They're tied to every operation, every decision, every customer interaction. That's not freedom. It's a cage of your own making. Consider Maria, who left her corporate role to open a bakery. 5 years later, she's a success by most metrics, but she hasn't taken a vacation in 3 years. Logs more than 70 hours every week and can't remember the last dinner she had without a work call interrupting. Now compare her to David, who started a property management company and from day one built robust systems, hired key staff, and now takes 2 months off each year while revenue keeps flowing in. What's the real difference? One built a high-stress job. The other built an automated system before you ever open your doors. Map out the 3 core functions of your venture: operations, sales and marketing, and financial management. For each area, create one essential workflow that you can hand off from day one. Think client onboarding under operations, follow-up messaging in sales, or invoice handling in finance. Next, pick tools to automate those tasks, perhaps Calendly for bookings, MailChimp for email campaigns, QuickBooks for billing, and Notion to document and track every step. Use this blueprint as your foundation. Then dive into Michael Gerber's The E-Myth Revisited or John Warrilow's Built to Sell for more depth on building a company that runs without you. If you can't take a fortnight off during your inaugural year without everything falling apart, you've built a job, not a business. Real entrepreneurial freedom means your venture generates cash whether you're in the office or sipping a cocktail on a beach, letting you travel, rest, or enjoy time with loved ones without refreshing your phone every 10 minutes. But a poorly structured enterprise can lock you down. Even worse is combining insurance and investment into one of the industry's most lucrative offers, whole life insurance. Essentially, fancy financial handcuffs. It promises insurance plus savings in a single package, and your agent will rave about it, largely because of the massive commission they earn. Whole life, universal life, indexed life, variable life. They all sound different, but share the same trap. Let's break down the real figures. A 45-year-old man seeking $500,000 of coverage might pay $400 per year for term life or $4,000 per year for whole life, 10 times higher. Most of that extra outlay goes to fees, commissions, and complexity, not to boosting your actual benefit. The industry loves to trumpet guaranteed returns and cash value growth, but they're remarkably quiet about how those guarantees stack up against simple index fund investing. Here's the kicker. When you pass away, your family typically receives only the death benefit. The cash value you've been building for decades stays with the insurer. That buried clause lives deep in a contract few people ever read. Remember Paul from Michigan? He paid $650 each month into his investment-linked whole life policy for 20 years. That's $156,000 in premiums. Yet his cash surrender value was only $98,000. Meanwhile, his twin brother Mark paid $50 a month for term insurance and invested the $600 difference into a basic S&P 500 index fund. Over the same 2 decades, his portfolio grew to more than $380,000. Both held identical life coverage, but Mark ended up with nearly 4 times the investment value. Think about your own situation. If you own a whole life policy right now, do you know exactly how much you're paying in fees? Do you understand how the cash value actually works? Most savvy investors opt for straightforward term coverage for 20 or 30 years, enough to protect dependents or cover debts, and then manage the rest themselves through low-cost index funds or ETFs. You get full control, clear growth potential, complete transparency, lower fees, and no 300-page contract designed to confuse you. We are now beyond the halfway mark of our list, and I'm curious which of these can't-miss investments you've been pitched over the years. Was it the whole life insurance plan your uncle raved about? Or that piece of real estate that stubbornly failed to deliver the cash flow you were promised? The financial world counts on us staying silent, but by speaking out, we can help others dodge the same expensive pitfalls. Let's dive into asset number 6, buying gold in the form of jewelry. It sparkles, it's glamorous, and it's a terrible vehicle for wealth creation. Your aunt probably told you it was a rock-solid investment, and your grandmother might have stocked up during times of uncertainty. Yet here's the blunt truth. Most of what you pay goes toward adornment, not actual gold value. When you hand over $3,000 for a necklace, you might be getting just $800 worth of gold. That means roughly 75% of your money vanishes into designer fees, craftsmanship costs, retail overhead, and massive markups. Industry data show that the moment you step out of the store, your new bauble can plunge in value by 30 to 70%, and finding a buyer willing to match your sentimental or brand-driven premium is nearly impossible. Most dealers only care about the melt weight, not the elegance or nameplate you fell in love with. Consider Susan from Dallas. Over 3 decades, she built a collection of so-called investment-grade gold jewelry, spending in excess of $25,000. When she retired and needed cash, the top offer she received was just $7,600, barely a quarter of her original outlay. The jeweler's response? They were only interested in the raw gold's melt value, not the intricate settings or designer pedigree she had paid hand over fist for. If you genuinely want gold as an inflation hedge or portfolio diversifier, you must play strictly by the rules. For physical bullion, deal only with reputable, accredited sellers, those certified by the National Futures Association or verified by the Better Business Bureau. Steer clear of anyone offering prices well below market rates or lacking robust security assurances. Alternatively, if you prefer a more hands-off approach, look into gold exchange-traded funds through established brokerages. Vehicles like the Gold Trust or the iShares Gold Strategy Fund trade just like stocks in your brokerage account, carry far lower fees than physical bullion, and eliminate all storage headaches. Don't get me wrong, jewelry carries emotional weight, tells stories, and can be profoundly meaningful. If you're buying it purely for beauty and personal enjoyment, that's fantastic. Just don't mistake a luxury purchase for a financial strategy. If you've been collecting sparkly pieces as your retirement plan, it's time to rethink that playbook before more of your hard-earned cash ends up in someone else's vault. Asset number 7, lending money to family and friends. Helping out loved ones feels like the right thing to do, but it can put your finances and your relationships at serious risk. You have extra cash, they need support, and you agree because that's what good people do. It all starts with the best intentions. Yet often the loan quietly morphs into a gift that comes with unspoken expectations. Without a contract, a repayment schedule, or clear terms, these personal advances create awkward power dynamics that linger at every gathering. Have you ever fronted cash to someone close and later wished you hadn't? Maybe you're still waiting on that next month payment promised years ago. Bankrate reports that 46% of people who lend money to friends or family end up with losses, broken ties, or both. And when the borrower never pays you back, you can't send in debt collectors. You just silently absorb the hit, all while they're out buying expensive toys and vacations. Consider the case of Robert A. Jazzy. He loaned his brother-in-law $30,000 for a startup, sealed with a handshake. 5 years passed, and Robert got back only $2,000. The venture collapsed, the brother-in-law filed for bankruptcy, and the family went silent. That $28,000 shortfall wiped out a big chunk of Robert's retirement fund, money he'll never see again. The answer isn't never to help, it's to structure your support properly. If you truly want to give with zero expectation of return, say so up front. This is a gift, no repayment expected. That kind of honesty prevents resentment. If you prefer a genuine loan, try wording it like this: I care about you and want to help, but I also value our relationship too much to let money come between us. Let's put clear terms in writing. Tools such as Xero or Loan Builder let you draft a simple agreement with firm payment dates. For larger sums, especially in business deals, think about investing instead of lending. I'd like to become a partner in your venture. If it thrives, we both win. If it fails, there's no debt hanging over us. Aligning incentives this way protects your peace of mind, your retirement, and your pride. Remember, you can't pour from an empty cup. Safeguarding your own financial health isn't selfish. It's the foundation that lets you be generous when it truly counts. What should have been your passport to freedom can quickly turn into a prison. Asset number 4, starting a business without a plan to step back. You spent years building other people's dreams. Now it's time to build your own. Launching that side hustle or small business sounds like the ticket to freedom. On paper, it looks perfect. But here's the truth nobody tells you at those motivational seminars. Owning a business doesn't deliver liberation unless it can thrive without you. Have you ever run into a small business owner who looks more overwhelmed and frantic than they did in a 9-to-5 job? According to the Bureau of Labor Statistics, 20% of startups fail during their first year, and by the end of year 5, half have shut their doors. But here's the twist. Even those that survive often morph into full-time grind routines, longer hours, higher stress, just a fancier title on your business card. Ask any honest entrepreneur about work-life balance, and you'll hear stories of responding to emails at 11 p.m., forfeiting weekends, and earning less per hour than they did as employees. Why? Because they built another job instead of a self-running enterprise. They're indispensable to every task, every call, every customer interaction. That isn't freedom. It's a cage you designed yourself. Take Maria, for instance. She left her corporate position to open a bakery. 5 years in, her revenue looks great on paper, but she hasn't taken a vacation in 3 years, clocks more than 70 hours every week, and can't recall a family dinner that wasn't interrupted by a work call. Contrast that with David, who launched a property management firm and, from day one, structured clear processes, hired key players, and automated core functions. Today, he takes 2 months off each year while income continues to roll in. What's the real difference? Maria built a job. David built a system. If you're about to start your own venture, here's your pre-launch playbook. Begin by charting the three main pillars of your business: day-to-day operations, customer acquisition, and financial management. For each pillar, establish at least one central workflow that someone else can own. For example, client intake in operations, follow-up messaging in marketing, or invoice handling in finance. Then choose tools to automate these workflows: an online scheduling app, an email automation service, invoicing software, and a process tracking platform. Use this framework as your foundation, and then dive deeper by reading Michael Gerber's The E-Myth Revisited or John Worrell's Built to Sell for advanced tactics on engineering a company that thrives without you. Remember, if you can't step away for a 2-week vacation in your first year without everything falling apart, you've simply built another job. True entrepreneurial freedom arrives when your business makes money, whether you're present or not. That's what allows you to travel, recharge, and spend quality time with the people who matter, without obsessively checking your phone. And if you think a poorly structured business can trap you, just wait until you see how insurance doubles as an investment, one of the financial industry's most profitable products. Asset number 5, whole life insurance, the so-called ultimate hybrid. Life coverage plus investment, all bundled together. Sounds ideal, right? Your insurance rep certainly thinks so, probably because they earn hefty commissions on those policies. Whole life, universal life, indexed, variable, the names vary, but the squeeze is the same. Here's the math. A 45-year-old man needing $500,000 in coverage might pay about $400 a year for a term policy, but roughly $4,000 a year for a whole life contract. That's 10 times the cost. And the majority of that extra outlay goes toward fees, agent commissions, and policy complexity, not your benefit. Surprised? Paying 10 times more for what seems like a slightly better product? The industry loves to trumpet guaranteed cash value growth, but stays remarkably quiet about how those returns stack up against simple index fund investing. The hardest truth: when you pass away, your loved ones usually receive only the death benefit. Any cash value you've built up over decades stays with the insurance company. You can't claim both. That little nugget hides deep in a contract, so dense it would stump a law professor. Consider Paul in Michigan. He handed over $650 every month into a permanent whole life policy for 20 years, a total of $156,000 in premiums. When he surrendered the policy, his cash surrender value was only $98,000. Meanwhile, his twin brother Mark chose 20-year term coverage at $50 per month and funneled the $600 of monthly savings into a straightforward S&P 500 index fund. Over the same period, his portfolio swelled to more than $380,000. Both had equal life insurance protection, yet Mark's investment balance grew to nearly 4 times Paul's. Pause and think about your own situation. If you hold a whole life policy today, can you itemize every fee you're paying? Do you truly understand how your cash value accumulates? Do what many financial professionals do for themselves. Secure simple term life coverage for 2 or 3 decades while you have dependents or outstanding debts, and invest the rest in low-cost index funds or exchange-traded funds. You'll enjoy greater control, stronger growth potential, full transparency, minimal fees, and you'll avoid a 300-page contract designed to confuse you. Now, reflect on the assets you've been pitched over the years. Maybe it was that whole life policy a relative recommended, or the rental property that never delivered the returns you expected. These traps rely on your silence, but by calling them out, we can help each other avoid costly mistakes. Let's move on to another supposedly foolproof asset, especially appealing during economic turbulence: Trap number 6, buying gold jewelry. It looks elegant, but it's rarely a profitable investment. Your aunt swore by it. Your grandmother collected it. They all said gold jewelry was a safe bet. Here's the blunt reality. When you purchase gold jewelry, you're mostly buying a fashion accessory with a 200% markup, not a serious wealth-building strategy. You're paying for design fees, brand prestige, craftsmanship, retail overhead, and then a hefty margin on top. So a $3,000 necklace often contains just $800 worth of pure gold. That means roughly 75% of your payment has nothing to do with the metal itself. Industry data shows that the moment you leave the store, most pieces lose between 30 and 70% of their retail price. And when you try to sell, buyers only care about melt weight. They won't pay extra for the sentimental value or designer name you spent years and premiums on. Take Susan in Dallas. She spent 3 decades collecting investment-quality gold jewelry, investing a total of $25,000. At retirement, her best offer was a mere $7,600, under 1/3 of her original outlay. The buyer made it clear they only valued the gram weight of the metal, not the intricate artistry she had paid wildly inflated prices for. Does that sound familiar? It happens far more often than you'd think. If you truly want gold as an inflation hedge or a diversifier, you need a far more strategic approach. For physical gold, work only with well-regarded, accredited sellers such as American Express, JM Bullion, or the United States Mint. When you're buying coins or small bars, double-check that any vendor you choose is registered with the National Futures Association or accredited by the Better Business Bureau. Steer clear of websites without robust security credentials or those offering gold at prices wildly below current market rates. That's almost always a red flag. If you'd rather skip the hassles of storage and shipping, consider gold exchange-traded funds through established brokerages like Fidelity, Schwab, or Vanguard. You can buy and sell popular ETFs such as GLD or IAU, just like stocks in your regular investment account, enjoying much lower fees and zero storage worries compared to owning physical bullion. Do not conflate jewelry's sentimental and aesthetic appeal with true investment value. While fine pieces carry personal stories and emotional significance, they seldom fetch their retail price on the resale market. If you're buying jewelry purely for its beauty, that's great. Just don't count on it to bankroll your retirement. Be crystal clear whether you're making a luxury purchase or a genuine investment. If you've been hoarding jewelry under the assumption it will serve as your financial safety net, it might be time to rethink that approach. The upside is, at least jewelry only puts your own capital at risk. The real financial landmine appears when you mix cash with friends or family in well-intentioned but poorly structured deals. Asset number 7, lending money to loved ones. It sounds noble, but carries significant financial danger. You spot a family member in need, you have the funds, and you say yes, because that's what good people do. At first, it feels like the right move, but more often than not, a friendly loan morphs into an unspoken gift with built-in expectations. No contract, no repayment schedule, and no clear timeline create an awkward power imbalance that can hang over every holiday dinner for years. Think about it. Have you ever lent money to someone close and later regretted it? Or perhaps you're still waiting for repayment promised months or even years ago? Surveys show that 46% of people who lend to friends or relatives end up losing money, straining relationships, or both. And the worst part is you can't hand the debt over to collections. You end up quietly carrying that resentment, watching them spend on luxuries while your loan remains unpaid. Consider Robert Tinn's experience. He loaned his brother-in-law $30,000 for a startup based on a handshake. 5 years later, he had received only $2,000 back before the venture collapsed. His brother-in-law declared bankruptcy, and the entire family went silent. That $28,000 loss wiped out a large chunk of Robert's retirement savings, funds he will never see again. Beyond the financial hit, he lost his relationship with family members. Was the risk worth it? How would you handle it differently? The answer isn't to stop helping those you love. It's to structure any assistance so it protects both your finances and your relationships. If you truly can give money without expecting anything back, label it a gift from the outset. Look them in the eye and say, "This is a gift, not a loan. I don't expect repayment, and our relationship won't change if it's never paid back." That level of clarity prevents misunderstandings and future resentment. If you do want to extend a proper loan, you must set formal terms. Draft a contract, establish a repayment schedule, and agree on deadlines before any money changes hands. You might say, "I really care about you and want to help, but I also value our relationship too much to let money come between us. Let's put clear terms in writing so we both know exactly what to expect." Then use apps like Xero or Loan Builder to draft formal agreements with specific payment dates. These tools even send automatic reminders so you never have to feel awkward about following up. When you're dealing with larger sums, especially for business ventures, consider taking an equity stake rather than extending a loan. You could frame it as, "Instead of lending you cash, I'd prefer to invest in your business. If it succeeds, we share the upside. If it doesn't, there's no debt hanging over our heads." This approach aligns incentives perfectly. A thriving business means a win for both of you, and a failure doesn't poison future gatherings with unpaid IOUs. You can still support the people you love, but don't sacrifice your peace of mind, your retirement, or your self-respect in the process. Remember, you can't pour from an empty cup. Securing your own financial future isn't selfish. It's the foundation that lets you be genuinely generous when it truly counts. Today, we explored 7 asset pitfalls that may look smart on the surface, but can secretly drain your wealth. Now you know how to spot each one and what to do instead.